You're listening to Capital Topics episode number 64. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. First, we'll give you an update on the performance of the Magnificent 7 stocks and the lessons investors should retain when investing in these high-flying stocks. And next, for a second topic, we'll review Warren Buffett's annual letter to shareholders of Berkshire Hathaway. Enjoy! Good morning, James. How are you today?
Good morning to you, François. I'm very well, thank you.
Okay, good. So I'll start. In our first topic today, we'll review the performance of the Magnificent 7 and how they have done year-to-date in 2024. We'll ask ourselves if it has been worthwhile to chase these high-flying stocks in the past.
Well, that's a great question, and everybody would love to know the answer to that. But before we go into the details, I just want to give our listeners a quick reminder of where the catchy label for these high-performing stocks came from. You may remember that at first in the mid-2010s, the acronym FANG came out, popularized by Jim Cramer on his CNBC TV Mad Money show. He used that label for a group of stocks based on the first letter of their names: Facebook, Amazon, Netflix, and Google. Google now, of course, is called Alphabet. And they had spectacular growth and performance. But later in the decade, Apple was added to the group. And so another A was added to the FANG. Mm-hmm. But then in early 2023, the term FANG was replaced by the Magnificent 7, as there was a group of 7 mega cap stocks by market capitalization, and they had become the largest by that same measure. The companies in that group are Amazon, Alphabet, Apple, Meta, which was Facebook before, Microsoft, NVIDIA, and Tesla. You'll notice that Microsoft and NVIDIA were added, but that Netflix is no longer part of that group. So that's why they needed a new name, François.
Yes. Thanks for the short history, James. I must say that this type of labeling by the street is nothing new, as it was also used occasionally in the past to refer to a group of market-leading stocks. Some will remember the dot-com era in the late 1990s or the Nifty 50 period in the 1970s. Now, getting back to the Magnificent 7, we highlighted in podcast number 59, when we reviewed the 2023 capital market results, how well these stocks had done in 2023. We mentioned then that their performance in 2023 ranged from 48% for Apple to an astonishing 239% for NVIDIA. Their performances, apart from Apple, were more than double the gains of the S&P 500 that gained almost 26% during the year. These 7 stocks that made up close to 27% of the S&P 500 index market cap weight contributed to almost half of the gains of the U.S. market last year.
Yeah, that's accurate, François. But it's also good to point out that at some point, as I highlighted back in January in the podcast number 59, that in the first half of 2023, these Magnificent 7 stocks were generating almost 100% of the gain in a U.S. equity market. So their dominance over the market in 2023 certainly has created a buzz among investors in the investment industry, which has prompted, as you would expect, several ETF providers to launch new products designed to profit from a concentrated bet on these stocks. So again, buyer beware. Only the future will tell if these ETFs pass the test of time and are going to be worthwhile investments. But this being said, François, how are those 7 stocks performing in 2024?
Well, James, as of May 24, cracks are starting to show amongst the Magnificent 7 since both Tesla and Apple shares are down so far this year. Apple shares are down roughly 1.1%, and Tesla is one of the worst performing stocks in the S&P 500 index with a performance of negative 27.9%, so almost down 28%. So slowing growth is apparently the main reason behind their current difficulties.
Oh, so how did the other 5 stocks do this year?
Well, the remaining 5 stocks are still contributing to the fabulous 11.2% performance of the S&P 500 index so far this year. Again, as of May 24th, NVIDIA remains the leader with a stunning performance of 115% return, followed by Meta at 32.2%. The other three are also performing well, with returns of 25% for Alphabet, 19% for Amazon, and almost 15% for Microsoft.
François, there's been a lot of talk regarding the weight of these stocks in the S&P 500 index and that represents a concentrated risk. So what's the weight of the Magnificent Seven now? And also maybe tell us what the top 10 securities in the S&P 500 weigh.
Well, the total market cap weight of the Magnificent Seven in the S&P 500 index is currently around 29%. The largest security is Microsoft with a weight of close to 7%, followed by Apple with a weight of 5.6%. It's worth noting that because of its poor performance year to date, Tesla is no longer amongst the top 10 stocks of the S&P index. The top 10 stocks now represent roughly 32% of the S&P 500.
François, is this concentration at 32% close to a historical high for the S&P 500? Should investors be worried?
Effectively, James, this concentration in the top 10 securities is high, but it's not particularly unusual. Based on data from Dimensional on the U.S. stock market going back to 1927, there have been periods when the concentration in the top 10 stocks was as high as it is right now. For example, in 1940, the top 10 stocks weighted 33% of the U.S. stock market. Similar concentration were also observed in the 1930s and in the late 1960s.
François, do you think their outperformance can continue and they can stay on top like this? I was reading Michael Harnett. He's managing director and chief investment strategist at the Bank of America Global Research. And he's the one who came up with the label, the Magnificent Seven. He said, and I quote, they all have monopolistic, oligopolistic positions, pricing power, secular earnings power, balance sheets that can finance AI, and so on. So what do you think? What does capital market history tell us about such a concentration?
To answer your first question, James, is I don't know. Can these technology companies keep outperforming the way they have? Can they stay on top? To me, only the future will tell. However, what I can confirm is that historically there has always been a rotation amongst the top 10 securities in the U.S. stock market and in any other international markets for that matter. If we go back to the year 2000, back then, cutting-edge technology companies were also dominating the U.S. stock market and making headlines. The top 10 stocks in the S&P 500 at the time included the following tech giants: Microsoft, Intel, Lucent, IBM, and Cisco. Today, these tech giants and all the other stocks that were in the top 10 of the S&P 500 have all disappeared from the top except for Microsoft. IBM, which was part of the US largest stocks for more than 6 decades, now sits at number 47 in the S&P 500 index with a weight of 0.4%. In 1985, the weight of IBM in the S&P 500 index was at 6.4%, which is close to Microsoft's weight in the index today.
Well, that's good to know, François. So there is a rotation. But I'll add another classic example of a major stock falling out of the top 10. Think General Electric. It had been in the top 10 for 9 decades. It's like 90 some years. And when, for many reasons, its business model collapsed. Meet recent Morningstar article titled 15 Stocks That Have Destroyed the Most Wealth Over the Past Decade. Puts GE at the number 1 position for destroying wealth in the last decade, ending December 2023, at an estimated US $55 billion in shareholder value lost.
Wow.
It is fair to say, François, that the top 10 stocks and the next best performing stocks 10 years from now will most likely be very different. So that's safe to say that. But again, we don't know what we don't know. And, GE was great for 9 decades, but then it wasn't. So something can work for a very long time and then it won't.
Yeah, it's fair. I think it's fair to say, James, that things will have changed 10 years from now.
So, what would you say then to investors, Francois, who may still be tempted to buy these stocks?
Well, James, it's possible that they'll continue to outperform the market in the short run. However, in the long run, I don't think they can reasonably expect these kinds of outsized returns from the Magnificent Seven. Their stock valuations are now considered to be high, and when stock valuations are high, future expected returns are lower. Investors need to remember that historical annualized return for the S&P 500 index dating back to 1926 have been 10.3%, and in 2023 alone, those stocks returned a market cap weighted return of 76%. Investors often have unrealistic performance expectations for these types of high-flying stocks or growth stocks. On that topic, Dimensional has studied the average annualized outperformance of companies before and after the first year they became one of the top 10 largest firms in the US.
Yeah, I saw that, Francois. So it's really interesting. So, why don't you share the results of what their study says?
Well, from 1927 to 2023, the average annualized return for these stocks for the 10-year prior to joining the top 10 was 11.8% higher than the market. For the 3 years before joining the top 10, their performance was 27.2% higher than the market. But here's the catch. 3 years after joining the top 10, their overperformance had dwindled to only 0.5% over the market, and 10 years later, these stocks were underperforming the market by an annualized 1.5% per year. Similar research from Antti Petajisto, PhD and former professor at Yale University, comes to similar conclusion. He wrote in his paper entitled Underperformance of Concentrated Stock Position, and I quote, "For stocks that have been among the top 20% performers over the previous 5 years, the median 10-year market-adjusted return falls to negative 17.8%, underperforming by 1.94% per year the market. Since the end of World War II, the median 10-year market-adjusted return of recent winners has been negative 93% of the time."
Well, based on this research, Francois, I think we can conclude that investors should not be chasing the past performance of these high-flying stocks. They should be very aware of the consequences of acting on their fear of missing out. I think individual investors should be disciplined to avoid making the type of behavioral mistake. At times like these, it's always good to refer to Warren Buffett's words of wisdom. In 2018, during Berkshire's annual meeting, when questioned by an investor about not buying Microsoft, Warren Buffett gave a long-winded answer, but finished by saying, "We missed a lot in the past, and I suspect we'll miss a lot in the future." What he's actually saying, François, for the benefit of our listeners, is that there will always be high-flying stocks.
Mm-hmm. Yes, and I think this says a lot, and it's a good frame of mind to have. If you have been building your portfolio with broad-based market ETFs, you have benefited from the performance of these high-flying stocks, and you will undoubtedly benefit from the next ones that come around in the future. Hitting a home run is nice, but it's not an investment plan for the future and for the long term.
That's a great line, François. So investors really should focus on their long-term objectives, diversify their portfolio across many different asset classes and countries, and they should follow our mantra and have an investor mindset and continue to buy and hold investments with an owner's mentality.
Yeah, correct. Okay, now for a second topic, we'll do a review of Warren Buffett's annual letter to shareholder of Berkshire Hathaway. Reviewing this letter is an annual ritual for many investors. Warren Buffett has been writing these letters since 1965. There are many serious books that have been published over the last years that have studied the letters to summarize Warren's pearls of wisdom on the topic of investing. I believe, James, we skipped the review last year in favor of other topics, but this year we felt we were overdue to cover this for our listeners. Why so? Because we feel that all investors, including ourselves, who have a disciplined passive investment philosophy, can learn from Warren's insight.
Absolutely right, François. For me, reading Warren Buffett's annual letter is always fascinating. You realize that the businesses owned by Berkshire can be explained in plain language. There's no need for the jargon so pervasive in the financial services industry.
Given how how long he has been writing Berkshire's shareholder letters. Reading through them offers a fascinating financial history of the past almost 60 years. Our listeners should know they are all easily accessible online for free. So, James, where do you want to start off the review of this year's letter?
This year, François, there's a lot to talk about because there's a lot of news. For our listeners, I will start our discussion with the news of the passing of Warren Buffett's longtime business partner, Charlie Munger, at age 99. The 2023 letter, Warren has written an homage to his late partner, and I quote, "Charlie was the architect of the present Berkshire, and I acted as the general contractor to carry out the day-to-day construction of his vision."
Yeah, the passing of his longtime business partner, Charlie Munger, was indeed a major event in the world of Berkshire. Many people may not realize how important Charlie Munger's role was in the partnership.
Well, that's really true. In fact, he's much less well known than Warren. So for our
Correct.
listeners, I will again quote Warren on his influence, and again from the 2023 letter. He says, "Nevertheless, Charlie in 1965 promptly advised me, Warren, forget about ever buying another company like Berkshire. But now that you do control Berkshire, add to it wonderful businesses purchased at fair prices and give up trying to buy fair businesses at wonderful prices." So in other words, he was telling Warren to abandon everything he learned from his hero, Ben Graham.
Yeah, for a listener, Ben Graham is widely known as the father of value investing and wrote two of the disciplines founding tax security analysis with David Dodd and The Intelligent Investor.
So, and the Warren Buffett quote in this year's letter goes on, "Many years later, Charlie became my partner in running Berkshire and repeatedly jerked me back to sanity when my old habits surfaced." I think, François, this quote says it all about Charlie Munger's influence on Warren Buffett.
Yeah, this is the important thing to remember for our listeners. They must have an investor mindset, means ideally they want to buy and hold forever. This is at the heart of our investment philosophy for passive investing. You don't want to be caught up in the noise of the moment. For listeners who would like to learn more about Charlie Munger, there's a great book called Poor Charlie's Almanac, The Wit and Wisdom of Charlie T. Munger, edited by Peter Kaufman. They have recently published the 4th edition. So James, now let's explain to our listeners what Berkshire does.
Okay, so many of our listeners may not know much about the actual business of the company. Warren Buffett explains it clearly in this year's letter in a section called "What We Do," and I will quote from the letter again. "Our goal at Berkshire is simple. We want to own either all or a portion of businesses that enjoy good economics that are fundamental and enduring. Within capitalism, some businesses will flourish for a very long time, while others will prove to be sinkholes. It's harder than you would think to predict which will be the winners and the losers. And those who tell you they know the answer are usually either self-delusional or snake oil salesmen."
Yeah, well, this is a very important point for our listeners. Stock picking is a very rare skill and hard to replicate. We know that Warren Buffett is not a fan of Wall Street and market forecaster. He has consistently recommended investors to put their money in broad-based indexes like the S&P 500. So James, Warren Buffett and Charlie Munger have shared many important lessons about investing over the year. What lesson is Warren highlighting this year?
Well, Warren is very clear about one key rule he never breaks. And our listeners really have to take this to heart. And we've shared it often on our podcast. From this year's letter, and I quote Warren Buffett, "One investment rule at Berkshire has not and will not change. Never risk permanent loss of capital. Thanks to the American tailwind and the power of compound interest, the arena in which we operate has been and will be rewarding if you make a couple of good decisions during a lifetime and avoid serious mistakes."
This makes total sense to me, James, and it's why we are always broadly diversified with our clients' portfolios in order to avoid permanent loss of capital. Again, people who invest in individual stocks always incur the risk of dilapidating capital. So now, James, many of our listeners are probably wondering, how did Berkshire get this big?
Well, it's really a great story, François, and I remind our listeners, we are not stock pickers and we're not in any way recommending the purchase or sale of Berkshire shares. Berkshire has performed so well that is now the 7th largest public company in the U.S. markets, again, as measured by market capitalization.
Yeah, as the seventh largest stock in the U.S., Berkshire has a 1.7% weight in the S&P 500 index and a 1.5% weight in the Vanguard Total Market ETF. That's as of March 31st, 2024. Investors like our clients in these broad market ETFs have benefited from owning Berkshire shares over the years.
Well, François, it may come as a surprise to some of our listeners. One of the reasons that Berkshire is now seventh is that Apple stock represented at year end 2023 nearly 50% of Berkshire's public stock portfolio.
Wow.
Again, that excludes all the businesses they own at 100%, the insurance, the energy, etc. But just to be clear for our listeners, it's not 50% of the total value of Berkshire Hathaway. As mentioned earlier, Apple is the second largest public company in the U.S. by market capitalization.
Yeah, the story behind how Warren Buffett invested in Apple is really fascinating. James, can you provide our listeners with some background on this topic?
Well, again, Berkshire Hathaway's become so big, it's very difficult for Warren to find investments that are going to have an impact. So the story is that after an initial purchase of nearly 10 million shares worth about $1 billion in 2016, Berkshire continued to add to its holdings later that year and then stepped up its buying in 2017, 2018, spending, in the end, $36 billion on the stock over those years. Berkshire later trimmed some of those holdings, but the move, François, has really paid off in a really big way. Today, Berkshire's 5.9% stake in Apple is worth about US $157 billion. Wow. Berkshire is sitting on about $120 billion in paper gains, likely the most money ever made by an investor or a firm from a single stock. Nothing in Buffett's long career comes close to that.
Yeah, that's staggering. But doesn't this make Berkshire shares riskier with such a weight in Apple?
Great question, François. In a recent Wall Street Journal article published May 3rd, titled "Apple is Buffett's Best Investment," it's also now one of his riskiest. Journalist Gregory Zuckerman addresses this question. He states that, and I quote, "Berkshire has scored an annualized return of more than 26% from Apple, including dividends, topping a gain of 12.9% for the S&P 500 during the same period." So the answer to the question of whether Berkshire stock is now riskier really is to misunderstand how Warren Buffett thinks about investing. On the one hand, as you pointed out, François, large companies that are in the top 10 over time start to underperform relative to the market. This Apple position is a concentrated bet, and we all know Warren Buffett is all about buy and hold forever. But that said, he has already started to trim the position.
Historically, Warren Buffett and Charlie Munger avoided tech stocks. They said they were too hard to value. What changed?
Well, François, this is again a perfect example of why stock picking is so difficult to do well. Chris Davis, who is on Berkshire's board of directors, is quoted in the same Wall Street Journal article, and he said, "Warren's ability to change his mind is what's so extraordinary because that's what most investors struggle with the most. Most of us anchor ourselves in our past statements, but Apple is a powerful example of the importance of being open to change." So, to me, François, because he has demonstrated over the years that he has the unique skill that if underlying fundamental change, he can make a decision to sell. In fact, a perfect example of this is in this year's letter, Warren has admitted making a major mistake with Berkshire Hathaway Energy. And that's an investment they control 100%. It's an electricity producer. And the regulatory environment has changed and it's very uncertain. So again, he has the ability to change his mind, and that's one of his key strengths.
Yeah. Berkshire is so big that the universe of companies it can buy in sufficient quantities to affect its returns is limited. Apple, with a market value of almost $600 billion at the beginning of 2016 when he first bought in, fit the bill at that time. It's still amazing that although he wasn't an early investor, he made a bundle of money in Apple. James, what is Warren Buffett saying now about the outlook for Berkshire shares?
Well, Warren Buffett is very clear about the outlook in the 2023 letter. He warned investors that Berkshire Hathaway has no possibility of eye-popping performance. And by that I mean is he doesn't expect he's going to, outperform the S&P 500 going forward like he has over the past 60 years. And again, it's a point he's made before about his size. Berkshire ended 2023 with more than $560 billion in shareholders' equity on its balance sheet. I mean, it's astronomical. That's like 6% of the retained earnings accumulated by all companies in the S&P 500, according to him in his letter. Back in 1984, again, as far back as that, Buffett warned, Berkshire was big enough that its growth will have to slow. And he said the same thing in 1990. He put it this way, a high growth rate eventually forges its own anchor. But then again, the stock has done very well since then.
Yes, James, but despite what he said, like you said, the company shares rose spectacularly since 1984. In recent years, the performance of Berkshire has been much closer to the market. In 2023, Berkshire shares returned 15.8% versus 26.3% for the S&P 500. However, so far in 2025, Berkshire shares have outpaced the market. So what should our listeners retain from all of this, James?
Well, there are many important lessons, François. First, what Warren Buffett has achieved with Berkshire is not matched by any other investor. He is the perfect example of skill that outperforms the market over the very long term. This skill is very rare and very hard to find. Warren Buffett has always said that the best option for investors is to invest in a broad-based index like the S&P 500. He is very clear that for investors to get the best outcome, they must adopt an investor mindset of buy and hold for the long term. The second lesson for our listeners, François, comes from Jason Zweig, who we have quoted often in our podcast, and he wrote a great article on May 3rd in the Wall Street Journal. And it was titled, "There's More to Warren Buffett Than Just Picking Great Stocks." In it, he said, hunting for a great stock picker is necessary, but not sufficient. You also need to find a great stock picker who isn't a pickpocket. So that's kind of funny.
Yeah.
But in this article, he points out that when you compare Warren Buffett to hedge funds or private equity funds and their outrageously high fees, investors really need to beware when fund managers promote themselves as being, quote, just like Warren Buffett.
This is a very important lesson for listeners, James. Very often in financial media, you hear, oh, we just invest like Warren Buffett. The reality is they don't. As Jason Zweig points out, for Buffett, his business strategy bred a structure that set him apart from other money managers and made shareholders a bundle. He goes so far to figure out what the difference would have been for Berkshire shareholder if he had charged hedge fund management type fees. I quote the article. Put another way, if Buffett had charged conventional hedge fund fees, his investor would have earned only 10% of the wealth they have enjoyed.
And that's mind-boggling, François. Only 10% of the actual gain would have been left over for them. Wow. So the lesson is watch out for high fees, especially nowadays when the financial services industry is moving to push investors into alternative strategies with very high fees.
Yeah, because Berkshire is a publicly traded holding company rather than a mutual fund or hedge fund, it doesn't charge fees. Jason Zweig points out in the fund management industry is structured exactly the opposite. He adds, Buffett never had to worry that investors would flood him with too much money at the market top or yank it out at the bottom. Most funds have fickle capital. Berkshire has permanent capital.
So, François, I would like to end this segment by sharing with our listeners that I'm always amazed how investors keep ignoring Buffett's advice. At the heart of what he is recommending is to have an investor mindset. You mentioned permanent capital, focused on the long term. Buy and hold for as long as it is sensible to do so, and make sure that you avoid investment funds with high fees. There's a lot more to what his investment discipline is all about, but this summarizes the essence to me, François.
Yeah, great summary, James. All right, so thank you, James, for sharing your thoughts and expertise today.
My pleasure, François.
So that's it for episode number 64 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode on July 4th. In the meantime, make sure to consult Capital Topics website for our latest blogs. See you soon.